From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, Chair Powell teeing up the Fed's next move. Evergrande debt sparking worries in China, putting bonds through a choppy week. We begin with a big issue, a whipsawed Treasury market.
When they indicated that they're going to taper sooner.
The flatter curve is kind of initial response.
We saw a flattening of the yield curve.
Right after the Fed meeting.
You didn't see a huge initial reaction on some of these front-end rates.
You got to squint to see that market reaction.
But you started to see that more over the past couple of days.
I feel like it's been a rational move here.
The steepening in the yield curve made a lot of sense.
It's been a little overdue.
There is a key technical level here on the 10-year at about 145.
We do look for the 10-year yield to continue moving higher.
If we break that, there is just not much in the way between 145 and 2%.
It's been a tough slog with that call.
Seems like it takes a little bit of time for the markets to kind of digest key news here.
145 on 10s, that is a change. We have an awesome panel to discuss this with. PGIM's Robert Tipp, JPMorgan's Lisa Coleman, and Kathy Jones of Charles Schwab. Kathy, first to you. What is behind what we've seen in this Treasury market at the back end of the week?
Well, the move up, I think, probably a little less to do with tapering per se as the relief over the China situation. So it looks as if that's going to get resolved in a way that doesn't produce a lot of contagion. And that was weighing on the market. But I think, the big picture story here is that the economy is doing well. Inflation is above the Fed's target rate. The economy doesn't need sharply negative real interest rates. And the market's coming around to that point of view.
Lisa Coleman, 30s at 197. What's happening here?
Hey, look, I agree with this view that the market's finally coming around. The Fed was very clear in terms of providing us with a roadmap. Taper begins, ends around the middle of next year. We're going to have the Fed pause for a period of time. Maybe it's going to be the end of 22, maybe 23. We think 23. And then we're going to start the process of rate normalization. Given our view that the economy is going to continue to do well, we think that rates should be moving higher. And this move, I'll give you the 10-year yield, how we're thinking about it. Around 175 on the 10-year makes a lot of sense to us.
Robert Tipp, 175. Does that make sense to you?
Well, I think you have to strip out, getting to your question of what's driving the market this week, the split between the endogenous economy, what's really going on, and what's been driven by the fiscal stimulus. And, last year we had this spectacular surge in growth on the fiscal stimulus, and that drove yields up to the 170s. At some point, people began to wonder, well, you're going to have some fiscal headwinds again. The stimulus is dropping off, and you actually saw activity leveling off and falling. You saw lower home sales, which maybe was, constricted by supply, and the same in autos. But overall, your nominal retail sales levels have fallen for months, for a handful of months. So I think that's what took us from those 170s down into the 1-teens. What you're seeing right now, I think, in addition to the Evergrande and the Fed moving the dots higher, is some reacceleration in the economic data on the housing side and in the retail sales, which begs the question, if the fiscal is already kind of tapering off and going into a negative sequential posture, so the fiscal is becoming a headwind, if the data is picking up, this is a really strong economy. And then the other question that's really important is the transient question, which to me is looking like transient means, through at least the middle of next year on high inflation.
Yeah.
And, that's putting, some fear in the marketplace, and it's reconsidering repricing.
Rob, there's a ton to unpack there. I want to pick up on a word Lisa used, normalization. Lisa, I've heard that word through this week a few times, and I've picked up on it, and I've asked the following question. What's normal for this Fed? What is normal anymore? What does normalization mean?
Yeah, it's a great question, Jonathan. I mean, the way I think about it is looking at where the Fed was giving us their long-run expectation of 2.5%. That, to me, is what I'm working off as kind of their view of what's normal. It's hard to know because we have so much conflicting data coming through. As we said before, bottlenecks that are creating all types of pricing pressures. We have issues with labor. I think the Fed doesn't have a good read on really what normal inflation should look like once we get through bottlenecks and labor shortages. So going back to this idea of this Fed's long run view of 2.5, what I think is going to happen is the Fed, I'll go back to the earlier comments, the Fed is going to taper. It's going to have a period of time, up to a year, maybe more, to actually look at what the data is doing. And then I think they can make a more informed decision of where we go on policy. And I think what's interesting about this time that the Fed is going through right now, it's not been a normal period of time where we start to see the deflationary pressures come in, take prices down, et cetera. We're starting with the Fed, who's looking at a very low unemployment rate and a very high inflation rate. And I think they're struggling with what is real and what is transient. So again, I'm trying to take the longer term view of what the Fed is looking at. And I also think, the way they're moving about with FAIT will give them the ability to have a little bit more latitude on where inflation is going to go and a little bit more flexibility in how they move policy.
This bond market has moved a lot this week off the back of this discussion. The belly of the curve's got a lot of attention through this morning as well. I want to talk about that this afternoon. The 5-year piece, the 5-year segment of this Treasury yield curve has gone from the low 60s into the 90s. Kathy, that's where this dance is playing out, the rate hike dance. And I just wonder from your perspective, let's interrogate the forecast together just for a moment. Inflation core PCE next year at the Fed, looking for 230, 2023, 220. And I just wonder, do you think they are underestimating the inflation that you think we're going to get next year and beyond, and what that means for the steepness or the shallowness, maybe, of the rate path still to come?
Yeah, I do think they're underestimating the long-run potential for inflation to beat their expectations. Now, if you're a policymaker, you don't want to admit that you're going to miss this for years to come, just as they didn't indicate that they were going to miss it in the past on the low side. But I do think that we'll see somewhat higher or stickier or more stubborn inflation going forward. We'll get a little bit of a dip on the other side of base effects early next year, but then we think it's going to be a little higher, and we think the demand side is still getting some help from fiscal stimulus. The child tax credit is helping low-income households. Higher wages for lower income workers, we think will help the demand side. And we think the global economy will continue to pick up as well. And global PMIs, are usually a good long run indicator of where yields are headed. So I do think the Fed is underestimating it a bit, but the belly of the curve is likely to really be pretty volatile for a while because the market has to assess where the Fed is going, and the Fed may lag behind, and the market is going to try to get ahead of it. You get one bad number, and and then we're going to see the curve shift again. But our overall picture is steep for the time being, and then as we get closer to those actual rate hikes, then it'll start to flatten out. Probably sometime next spring. 96
basis points on 5s right now. This is the quote from President Mester earlier on today that I wanted to touch on. Expecting conditions for liftoff to kick in by the back end of next year. After liftoff, we'll need accommodative policy for some time. This is the debate that I think, Rob, is important for this segment of the yield curve for 5s. Just how loose will potential tightening actually be?
Well, I think what's going to happen with the dots is that they're going to continue to rise. And the most relevant ones in terms of impacting what actually happens are the end of next year's dots. I think that if the inflation numbers are a little bit higher than they're comfortable with through the end of next year, and the economy is holding up very well, and they're done with the taper by mid-year, then it's going to be difficult to make the case for not raising rates a few times in the second half of next year. And so I think that the front end of the curve is the part that is the most at risk. The back end of the curve has taken the prospects of the Fed tapering and raising short rates very well. And I think that's likely to be the case as long as the market continues to hold this perception, which it has held so far, that these numbers that the Fed has in their dot plot in the out years, in the 2% area and so on, that those are completely specious, and that was proved in the last cycle, that you're not going to see two handles on Fed funds rates in the future. But that's the dynamic that I think is going to flatten the yield curve. It's going to be bearish for the front end, but not a problem for the back end.
So, Rob, do you like 30s at 2%?
Yes.
Have you been buying this week?
I'm not going to, speak to portfolio positioning changes in portfolio positioning, but I think the normal is the 130s, 140s kind of level on 10-year treasuries, and that we've had the prospect this year of a twin peak environment where we had high yields in the first quarter, then things kind of backed off. And then as people become impressed with the growth resumption and the high inflation numbers, you get a twin peak in the second half of the year. But in the end, if this Fed, I think, will end up hiking a couple times, and by the time they get to that point at the end of next year, you'll find out that it was transient, and those forwards will continue to come down. Those long-term interest rates will have been value in this 140 to 2% area.
You know that Lisa, Kathy, and I all think that you've been buying 30s this week, regardless of what you say now. We'll leave that there, Robert. It's okay. Robert Tipp, Lisa Coleman, Kathy Jones, sticking with us. Up next, the auction block. Lingering Evergrande issues weighing on new corporate debt sales. That conversation next. It's China. From New York, this is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off here in the United States with high-grade bond sales fluctuating amid rising volatility. Volume falling short of estimates with just 2 active sessions throughout much of this week. It was a different story in the junk bond market, registering its busiest week since mid-August, taking monthly sales close to $30 billion. And in Asia, Chinese firms rushing back into credit markets with 4 borrowers offering dollar bonds to close out this week. China has been the big story throughout much of this week. Evergrande taking everybody's attention away at the start of the week. This is what Leland Miller of the China Beige Book had to say about China's growth model. Take a listen.
If you just accepted slower growth. Now, look, foreign investors, commodity firms, everyone's going to be thrown for a loop globally. But China itself could embrace slower, healthier growth. It would improve the dynamics inside China. It would stop the debt buildup. All of a sudden, capital could go to productive uses instead of non-productive uses. It would be extremely important for China. And I think that's why the party is doing it right now. The true risk here is that foreign investors just haven't gotten the memo, and they're not expecting what's coming next.
Lisa Coleman, I want to come straight to you on this. I think it's so important not just to have a conversation about a so-called Lehman moment and to talk about this shifting growth model in China and what it means for people's portfolios. What does it mean for you? How do you navigate these waters right now?
Yep. You know what? Look, I mean, the situation that we find ourselves now with this company, I don't think it should be any surprise to anyone. And let me start first by talking about, I think about this as I would any corporate bond that I look at. I mean, this is a company that was problematic for some period of time now, running an excessive amount of leverage, understood by the government and received essentially warning by the government that they have too much leverage. This was not, this was going to be a problem at some point. Overlay this with the idea that China is now going through a process of trying to take excessive leverage out of the housing market. The plan that they now have with houses for the living or houses for living, this to me was just really a situation waiting to come to a head. And that's indeed what we had. And now, I know a lot of people have been talking about the implications for China, for broader growth. If we take a step back and think about this country, yes, the numbers or about this company, the numbers are quite eye-watering. However, when we look at the amount of liabilities that are actually going to bondholders, it's actually quite small by comparison. And much of the liability is actually falling with suppliers and with people that have contracted to buy homes. The government essentially is indicating that they are going to protect these people, that they are going to see homes come to fruition. Yeah. And we also believe that they're going to protect suppliers. So when I start to think about how this all adds up for growth, I think this is well flagged. The government will do its best to try and make this not be something that is going to be problematic for growth. They have the PBOC adding liquidity. And you know what? I think it's something that's captured our attention now. But the impact on the banking system in China seems to be relatively small and widespread. And I do think that they're addressing the growth implications that it could have.
Kathy, do you share that confidence?
Yeah, I'm not too concerned about Evergrande per se. Corporate defaults in China have been rising over the last year or so, and high yield spreads have been widening a bit. So that's a bit of a concern. And I think that does reflect China's shift in its growth model away from this highly leveraged, sort of speculative type of growth to what they're trying to achieve, and something more, socially acceptable and more sustainable growth rate that isn't just due to a lot of leverage. When it comes to the market, the dollar bonds from Evergrande really comprise a very small amount of the EM bond market. So we're not really too concerned about that. I think the question is, how well does China pull off this transition in its growth model? Because China has been a big driver of global growth for a long time. And if we're shifting to a more mature model, what does that mean in terms of global growth? We're still pretty optimistic about the next year or two, but from a longer term perspective, that could make a big difference in how we look at global growth long term.
Rob, a couple of ways to look at this, just to build on the things that Kathy and Lisa have already said. Either it's an individual, idiosyncratic, single name credit risk story, or it's a symptom of a broader macro issue we need to pay a lot more attention to. What do you think it is right now for you, Rob?
Right. Well, I think it's both of those things. I think on the macro side that, China's growth is slowing down and they need to work on inequality. And as has been, recognized by U.S. policymakers, for example, Janet Yellen in particular pointed it out when she took over at the Fed, that one of the biggest drivers of inequality is having financial market crashes. Because the people in the bottom half of the society recover more slowly. And so rather than, wait for their WorldCom and Enron to crop up, or their 1990 junk bond market debacle to happen, they have put the pressure from a macro prudential standpoint on these companies to meet certain criteria in terms of equity capitalizations, limiting their debt, and so on. They're bringing it on themselves. So we had our Enron and our WorldCom and our Sarbanes-Oxley, and instead they're trying to have the stitch in time saves none kind of philosophy. So that as growth, is slowing down, they're trying to get the growth better distributed over time, and one way to do that is to control credit risk. And their credit risk, their credit market has been burgeoning with very narrow credit spreads. And so they're trying to introduce some discipline there where it's not naturally coming about on its own.
When we started this week and started to explore this issue with a little bit more detail, I was thinking about some of the trades that might be vulnerable to a downshifting growth in China. And first of all, like many, I thought of Europe. And Lisa, then I saw your notes. And you mentioned Europe, but you come at it from a very, very different angle. Can you walk me through what you're concerned about in European credit markets at the moment?
Sure, happy to. So look, I mean, we've had European companies enjoying a period of time where they're having robust EBITDA growth. We're starting to see leverage come down. Margins are at the highest level in aggregate since we've seen in 15 years. All looks pretty good, right? But we know that underneath this, margins are starting to come under a little bit of pressure. And, a lot of people have been talking about that in the context of the US. Many of the same problems are plaguing European companies. Supply chain issues, labor issues, et cetera. But the one thing that now has recently cropped up is the impact on margins from higher energy prices. The rocketing in the price of natural gas is going to prove problematic in a variety of ways, I think. So first, it'll cut into margins. And there was a recent analysis of chemical companies. And the estimate is that, going into next year, if higher energy prices remain an issue, that'll shave 2 to 3% in terms of price costs that they're now going to have to embed, either taking that through margins or raising prices. If you look at the cost to the consumer, shifting focus away from companies, this is something that governments may have to pick up the cost of. So I think this is something that we need to be aware of. This could all go away if we have a mild winter in Europe, but if it doesn't, then I think it's one more thing to take into account when we're starting to look at the resiliency of margins going forward.
Really important point. Lisa Coleman there, Robert Tipp, Kathy Jones, sticking with us. Still ahead, the final spread, the week ahead, featuring Chair Yellen, Secretary Yellen rather, and Chairman Powell together testifying down on Capitol Hill. That'll be next. This is Bloomberg. Live from New York City for our viewers worldwide, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, another busy slate of Fed speak with Brainerd, Evans and Williams kicking things off on Monday. Chairman Powell and Secretary Yellen testifying before Congress on Tuesday and Thursday. The world's biggest central bankers gathering for the ECB forum on Wednesday. ISM manufacturing numbers out of the US closing out the week on Friday. Quick final word on something you mentioned earlier, Lisa Coleman. I want to come to you on this. The margin pressure you think we're going to see, how are you expressing that right now in the credit market?
Well, we're still relatively bullish on credit because, while margins are at the highs right now, they have still plenty of room to be supportive of corporate credit. Right now, it's just really a matter of being more cautious, looking at sectors where we think we could see a little bit more pressure. One that comes to mind is the food space, being a little bit more defensive in terms of our holdings there.
Interesting.
And then in other spaces where less margin pressure, we're willing to ride with higher exposures.
Just wanted to make sure we squeeze that in, Lisa. Can't miss the trade. Can't miss the trade. Let's get to the final round, the rapid fire round. 3 quick questions and 3 quick answers if we can. When do we see the first hike? 22, 23 or 24 or beyond? 22, 23, 24 or beyond? Rob?
22.
Lisa?
23.
Kathy?
22.
What do we see first on 10s, 1% or 2%? I ask this quite often. I want to ask it again because I just wonder if expectations are anchored somehow by what happens with price. 145, what do we see first, 1% or 2%? Kathy?
2%.
Lisa?
2%.
Rob?
1.
And your third and final question. Who hikes first? Do you remember this race back in 2014? It was between the Fed and the Bank of England, then the Bank of England faded away. Who hikes first, the Bank of England or the Fed? Rob?
Bank of England.
Kathy?
The Fed.
Interesting. Lisa?
Bank of England.
Lisa Coleman, Robert Tipp, Kathy Jones. Guys, thank you. Enjoy the weekend. Thanks for your time this afternoon. And thank you to you, our audience worldwide, for choosing Bloomberg TV. From New York City, this was Bloomberg Real Yield. This is Bloomberg TV.